Ira Serkes, and Carol is in back. You met her when you come in, and we're the hosts of The Art of Downsizing. Aubrey of Hone Maxwell, talking about taxes and real estate, and the issues will be how to move your low Prop 13 property taxes to your next house. How do you qualify to do that? What are the things you need to be aware of? What are the things that you can do and can't do?
So I'm a tax attorney in San Francisco, and we're going to talk a little bit about how you calculate the gain that's in your house. We're talking about downsizing. Presumably a lot of people have owned their homes for quite a while, and so and in the Bay Area, it's often people have gain, thankfully, when they sell their homes. So we're going to talk a little bit about calculating the gain in your house, how it's determined, the exclusion you get if it's your primary residence, and how that applies, the tax rates that are going to apply, and then we'll move on to a little bit about the property taxes. So first is just some basics about capital gains itself. So calculating your gain. So basically in the tax code, your gain is your sales price less your what's called your tax basis. And your tax basis is what you paid for the house originally plus your capital improvements, which are things that add value to the house. So painting, no. A new roof, yes. Right? So a kitchen remodel, a bathroom remodel. If you've been in the house for a long time, do you have records for all of this? But ideally you do. Of course, it's important that you keep records. So if you don't, though, going kind of back through your records, what you do have, what you can find, listing out now while you're kind of getting in the process. What's all the things I've done? What records do I have? What did I pay for it originally? You can kind of back yourself into roughly what is your gain in the property. And then, so basically, obviously, if it's just sales price minus basis, the higher your basis is, the lower your gain. So that's obviously the key here. Your tax rate, in California, there's no preferential rate for capital gains. Your gain is going to be taxed at the same rate as all your other income. So the max rate in California is 12.3%, so that's kind of your top rate. It may be lower depending on all of the income that you have, right? And depending on how big your gain is. So it's somewhere in just the standard rate structure for California. There is the mental health services tax, which is an extra 1% for everything over $1 million in taxable income. So if you have a really large gain, if you have a $800,000 gain or something in your house, you might get bumped up into that mental health tax that you don't normally pay. So that's something to just keep in mind. On the federal level, capital gains do have preferential treatment. For most people, the rate's going to be 20%. It can be 15%. But for most people, especially in this area, if you're selling a home, you're going to be up at the 20% rate. However, we also have this sneaky tax called the net investment income tax, which came into the code on January 1st of 2013, and it was kind of what Congress's really sneaky way of increasing taxes without anybody knowing it, because they just added a new tax instead. And the net investment income tax applies to investment income, which would also be a gain in a home that you sell. So it doesn't apply to things like your earned income, your wages, those types of things, but your interest, your dividends, your capital gains. So we'll talk a little bit about that. So really, the federal rate is really 23.8 for most people, but it's because there's this second tax. I put together an example. So if you sell your home for $1 million, you bought it for, let's say, $100,000 25 years ago. You put $100,000 into it over the last 25 years. Again, record keeping is essential in this. Not often, I'll be frank, I handle a lot of audits. It's not that frequent that the IRS audits and really digs into, can you prove that you added this roof in 1987? They don't kind of dig that deep generally, especially because if you're already reporting a gain. But the more records you can dig up, the more you can write down and kind of take pictures of what you've done, right? That's one thing I always tell new homeowners is if you do anything to your house, make sure that you take, here's the old bathroom and here's the new bathroom, right? So then you have proof that you did remodel the bathroom, even if the receipts are gone with the wind. So here, so we have $1 million. Our basis, right, is $200,000. Our $100,000 that we paid for it originally, plus our $100,000 in improvements. So we have an $800,000 gain in this house when we sell it. So again, these are the rates. So if we pay at 12.3, we have a $98,400 tax bill from the state. If we pay 20%, $160,000 to the feds. So we have a $259,000 almost tax bill on that gain. And again, this doesn't consider if you have an $800,000 gain, whether you got bumped into the 1% and the 3.8%. So really, you can be up to paying 36, 37% tax on your gain. So just keep that in mind when you're thinking about how expensive the tax bill might be. I'm gonna let you do questions in a minute. Now, there is an exclusion specific to your primary residence. You have to have lived in it as your principal residence for at least 2 of the last 5 years. So even if you've moved, within the last 5 years and you don't sell the property immediately, you can still get it as long as you sell it within the 5-year zone. So it has to be 2 of the last 5 years. It's $250,000 per individual or $500,000 for a married couple. And that's true even if only one of you owns the home. So if you're a married couple and only let's say it's a second marriage or something and only one of you owns the home, you can still get the $500,000 as a married couple, even if you only own. And then that's the 2 of the last 5 years. So I did the same calculation here, but obviously we have a $300,000 gain, right? So we had our $800,000, and then you get to take your $500 off if you're a married couple. So now you're down to your $300,000 of gain. So we're down to $97,000 of tax. So we went from our $259 roughly down to, so it's a really big benefit. I mean, it's a really big benefit. So $161,000 in tax savings being a married couple in this example. So the net investment income tax, as I mentioned, it went into effect January 1st, 2013. The big kicker here, and I want to note for you that this does not get indexed for inflation, so these numbers stay year after year after year. This applies to as soon as you hit $250,000 worth of adjusted gross income. So it factors in whether the 3.8% applies to your investment income is based on your overall income. Does that make sense? So all your wages and all your other income determines whether you've hit these thresholds, and then it applies to your investment income. So it's 3.8%, like I said, on investments, so it's interest, dividends, capital gains. If you have rental properties, your rental income, royalty income. And so these are the thresholds, which in this area are fairly easy to get to. And if you're selling a house with a gain, you're likely to get there pretty quickly, given the fact that you likely have other income that's going to get factored in as well. So most people in the Bay Area are paying that 3.8%. So that's the basics on capital gains. Now I'm just going to touch on Prop 60 and 90. So this is our Prop 13, where we get to take our property tax base, right? A low property tax base, and we get to take it with us to our new house. So Prop 60 is for people that are moving within the same county. Prop 90 is you get to if you're moving counties. Only 10 counties are allowing you to do a Prop 90 property tax transfer. Alameda happens to be one of them. These are the 10 that currently allow for it, but they highly recommend that you contact your county assessor if you're getting ready to move to make sure that you can actually transfer it. The requirements are, 1, that you or your spouse must be at least 55 years old when the house is sold. And it doesn't matter, you can't turn 55 within the year. You have to be 55 when it is sold. So even if you're within a couple months, that doesn't work. You have to be that age. The replacement property must be your primary residence, and it must be of equal or lesser current market value. And they have a specific definition of equal or lesser based on how quickly the replacement property is found. So if it's before you sell, it's 100% of the value. If it's within a year, it's 105%. If it's within 2 years, it's 110. The replacement property must be purchased within 2 years. So you really only have that 2-year window maximum. You can file the claim retroactive, and so that's kind of the basics of the Prop 60 and Prop 90. So generally, if you're within the same county, you're going to probably be good to go, again, considering value and age, but the inter-county, the Prop 90s are a little harder to make happen. But in Alameda, you likely can. So I wanted to touch on one other thing before we move off of this, which I thought I had in a slide, but apparently I left it off. Well, I actually want to touch on two things. First of all, one thing to keep in mind about that gain calculation that we did, where we came up with, $200 and something thousand. If you have a home with a lot of gain in it, sorry, I just wanted to pull this up really quick. One of the big benefits in California, where we live in a community property state, is that when you own your home as community property, if you leave it to someone when you die, meaning you hold on to a clear until you die, if you leave it to someone when you die, they get what's called a step up in basis. So we calculated our basis, right? In the example that we have here, we have $200,000 in basis. When you pass away, if you leave it to your spouse, all of that gain, they get a stepped up basis to current fair market value for both their share in the property and your share in the property. So that means their basis, when you died, went up to $1 million, and all that gain just disappears, okay? So that's a really big benefit of if you decide to hold on to the home until you pass away. We're talking about downsizing, so that's a little bit different, but that is something to keep in mind, is it is possible for the gain for you to never pay tax on that gain. By leaving it to your spouse, and then when they leave it, if they leave it to children, again, it gets stepped up. So it gets stepped up if you transfer it at death. So that's something to keep in mind. Another thing which Ira asked me to mention is if you're about to buy your, let's say a condo or something, and you haven't sold your current home yet, and so you need a little cash. One thing that you can do is access money from retirement plans, 401ks, 403bs. IRAs, you can only access $10,000, and it's usually on very limited basis. So that's IRAs, not generally. But from a 401k or something, it depends on the plan. So you always need to speak to whoever your plan administrator is. But often you can get a loan out of it for up to half of the value. So you can take a loan and then just pay it back as soon as you get the property sold. So that's just something to keep in mind as far as accessing cash if you need to do that if you're not going to sell before you buy. So, questions. So the question was, what if your spouse died in 1996 or 97? Do you still get the $500,000? You do not get the $500,000. You would get the $500,000 if you sell it now while you're married. So you could have a new spouse, and you would still get the $500,000. You also do, though, get a step up in 1997 or 96 when she passed away. So your basis is not what you bought it for in 1975. It's whatever the value was when she passed away, plus the improvements you've made in the interim.
This is only federal, right? That's federal.
It's for California as well.
Yeah, how long do I have to be married?
You can be married a day.
There you go.
You just have to be married. So if you're looking, if you're on the market. Yeah, you don't have to be married a certain amount of time. You have to file a married tax return. Yep, yeah.
If I were to sell our house up in the hills, and instead of purchasing a private home, I bought something like a duplex, which our daughters could have after we die, can you still get the Alameda County tax relief?
The tax base transfer? You can, but there are very specific rules when you're switching from a multi-unit to a single family or vice versa. So you would have to look into the specific rules, and I would say call me or call your CPA or a tax advisor and make sure that you understand it before, because there are specific rules when you live in a multi-unit and then you switch in either direction.
We live in one of the units.
Right. And that's the other thing, is that you may only get a portion of it because only a portion is going to be your principal residence, right? So that's why there's specific rules about when it's a multi. Yes?
When you're figuring capital gains, where does the amount that you currently owe on a mortgage come in? Do you deduct that from the sale price since it will have to be paid out?
No, that doesn't count. So since what you paid for the house is your starting basis, even though you might still owe on the loan, You don't factor in what you owe on the mortgage at all in figuring your gain. But one thing I forgot to mention, which I'll just put a plug in, is that one thing to keep in mind, so we figured out how we calculated our gain based on what our basis was. But the other thing you get to reduce your gain by is your selling expenses. So the cost you spent to get your home ready to sell, including your staging and your painting and your et cetera, you get to deduct. So that $800,000 can go down by what it costs to get your home ready to sell. The big thing about that is that you have to make sure that you can't have painted 2 years ago and now say, well, it was to get ready to sell and now I sold it this year. There's got to be a pretty close time frame there. But your cost of getting your home ready to sell, your closing costs on selling, that also reduces your gain. I didn't put that in the example, but that is something to keep in mind. So the cost to get your house ready is something that will reduce your gain as well. So she said, if you've had your house for 40 years and you've put a new roof on it twice, do you get to count both? And you do. So it's all of the things you're doing to maintain and keep your home valuable count. So it's considered a capital improvement, in other words. So that counts. The painting you did 5 years ago won't count. The painting you do 2 months before you sell, so is it Gary or Greg? I'm sorry. Gary, so that Gary can get it ready, that one does count.
And then the harder question, I'm still based on net investment income tax.
Yes.
What if you earn under $200,000 a year? But let's say you had $1 million capital gain on the house. I'm not sure what you're combining that you think.
So the 250 is, or the 250 or 200, depending on your filing status, is all of your income together. So if you hit that 250 or 200, whatever your threshold is,
With the capital gain.
then, yeah, right, including your capital gain, then you're subject. That's why I'm saying almost everyone's subject. But things like your wages, you won't have to pay an extra 3.8% on just because you got bumped into meeting the threshold, but you will pay it on your investment income. Back corner.
I wanted to ask about the property taxes. So you have the counties listed there. Those, generally speaking, if you stay within the county, you have a good chance of maintaining a property?
No, that's for every county in California. Those counties that I had listed are the ones that allow it if you move from a different county to their county.
In their county. But
Yes.
if you left that, the one that wasn't listed there, then you can probably.
Then you're out, right? So if you move from here to San Francisco, you're out. But if you move from San Francisco to here, you may be able.
Costa, for example.
Exactly. Yes. Yes. Yeah. Okay. One more question.
Can you be more specific about the time that you have to make these improvements in? Is it a year?
So the difference is that, so a capital improvement always counts. It always adds to your basis, whether you did it 5 years ago, 10 years ago, 20 years ago, right? So your kitchen remodels, your roofing, your major improvements to your home are always going to count. New plumbing, new electrical, that kind of stuff. Things that are just cosmetic improvements, painting, carpeting, things that aren't going to last and add value to the home, in a long-term sense, they're not considered a capital improvement. Those have to be close to the time that you sell in order to be considered a selling expense.
What's close?
Well, that's kind of that's not a defined thing. So I would say within 6 months, if you can show you were preparing, you'd already talked to a realtor, maybe you already had a realtor. So it kind of depends. Again, it just has to be, what I would say if you were my client is we need to have a good argument as to why this was a selling expense and not painting that you did because you wanted to paint and then you decided to move later. But if you've already taken action to get the home ready, you've already met with some people to get it ready, they recommended that you paint, even if it's 6 or 9 months later, I would think it's fine, especially if you've already listed it, even if it doesn't sell for 9 or 10 months, clearly you did it to sell it. So that counts. But that's basically it.